What if I told you that having absolutely zero reportable personal income on your standard employee tax forms
Yeah.
could actually make it easier for you to borrow like millions of dollars to buy real estate?
It sounds completely backwards.
It sounds totally backwards, right? But today we are jumping into this hidden financial ecosystem
Mhm.
where your personal employment resume basically barely matters,
Right.
and the physical house's resume is essentially everything.
That's a great way to put it.
Yeah. So today's mission for this deep dive
Yeah.
is to explore the high stakes, really fast moving world of real estate investing.
Mm.
We are pulling from this massive stack of guides and articles um, published by a San Diego lending firm, and they specifically map out all these alternative financing strategies.
Yeah, the real inside baseball stuff.
Exactly. So we're looking at how professional investors operate in these hyper-competitive markets globally, using San Diego as our prime example here.
Right. Highly competitive.
Right. And how they move millions of dollars when traditional banking is just, I mean, entirely useless to them.
It really is a completely parallel financial universe. When most people think of buying a house, they picture the standard institutional process, right?
Yeah, you go to a bank.
You find a house, you sit down with a bank officer, you hand over years of tax returns, and then you just wait.
Yeah, lots of waiting.
It is a highly regulated, consumer-focused machine, but if you don't fit their exact, rigid checklist, that machine just grinds to a halt.
Completely.
And for professional investors, that kind of bureaucracy is literally a deal killer.
Well, the sources highlight this as the massive bottleneck of the whole industry, honestly. Like, a traditional bank takes anywhere from 30 to 45 days just to close a mortgage.
At best, yeah.
Right, at best. And why? Because they're cross-checking your employment, they're verifying, every single deposit in your checking account,
Hmm.
and making sure the property is completely flawless. But if you're in a hot market and a seller has a distressed property, say, like an inherited house with a collapsing roof that they just want to be done with,
Yeah, they want it gone.
right, they are absolutely not going to wait a month and a half for your bank to clear all that red tape.
No, definitely not.
Okay, let's unpack this. Traditional banking is essentially like trying to navigate a slow-moving cruise ship, right?
Yeah, I like that.
Yeah, it's a cruise ship moving through all this red tape.
Right.
But the market, especially in places like San Diego, it requires a speedboat.
Yes.
You have to move fast. And for those watching the video feed, you can actually see the backdrop we've set up for today. It's this dynamic mix of a bustling modern cityscape overlaid with these complex architectural blueprints.
Yeah, it perfectly represents what this deep dive is fundamentally about.
Yeah.
Because we are talking about a massive paradigm shift in how value is assessed.
Wait, break that down.
Well, the conventional banking world looks backward, right? They assess risk based on your historical personal income, your W-2s, your past credit.
Right, which you did last year.
Exactly. But this alternative ecosystem we're looking at, it looks forward. It focuses almost entirely on the intrinsic equity and the future potential of a physical asset.
Oh, wow. So because the cruise ship approach of traditional banks is so slow, we need to examine the exact mechanism that investors use to bypass them
Right.
and get in that speedboat.
Mm.
So according to our sources, conventional banks will flat out reject properties for reasons that seem, well, trivial to an investor.
Oh, totally.
Like if a house lacks a functioning kitchen, or if the inspector finds a bad termite infestation, a conventional lender will just deny the loan.
Yeah, they won't touch it.
They require the asset to be habitable and turnkey. But if I'm an investor, I mean, I want the house with no kitchen.
Exactly.
That's where the profit is.
Precisely. Conventional banks are tightly regulated to protect the everyday consumer.
Right.
And they package these loans and they sell them on secondary markets. So the product, the house, it has to meet a standardized baseline of safety and habitability.
It has to check all the boxes.
Right. But investors aren't looking for a finished product. They are looking for a raw canvas. And if a bank won't fund a raw canvas, well, the investor has to seek out private capital.
And I'm looking at the speed difference in the sources, and honestly, it's hard to wrap my head around. A bank takes 45 days, but private capital can close a real estate deal in 5 to 10 days.
Sometimes even faster, yeah.
Which is wild. And that speed allows investors to submit offers that are essentially cash-like, right, with zero financing contingencies.
Yep.
From a seller's perspective, I mean, if they have two identical financial offers, but one promises cash in hand next Thursday regardless of an appraisal.
Yeah.
And the other might fall through in a month because of some bank underwriter.
Hmm.
I mean, the fast offer wins every single time.
It wins even if the fast offer is slightly lower in actual dollar amount.
Wait, really?
Oh, absolutely. Certainty and velocity have a tangible monetary value in real estate.
Huh. Well, I need to act as a surrogate for our listeners here, though, because the terminology the sources use is really throwing me off.
Okay, what's that?
They keep referring to this private capital as hard money.
Ah, yes.
And I'll be honest, the term hard money sounds incredibly sketchy.
It does.
It brings to mind, borrowing from a loan shark who's going to break your kneecaps if the project runs late.
Right, The Sopranos or something.
Exactly. Why would anyone, especially a sophisticated business operator, willingly sign up for a loan that sounds this intimidating?
What's fascinating here is how the legacy terminology of the industry contrasts with the modern factual reality.
Okay.
The sources make a very clear distinction. It is much more accurate and, frankly, less dramatic to call it asset-based lending.
Asset-based lending.
Right. The capital isn't hard because the lenders are ruthless. It's called hard money, strictly because the loan is secured by a hard asset.
Ah, I see.
The concrete, the wood, the dirt, rather than the soft guarantee of your personal credit score.
Oh, wow. Okay, that strips away the Hollywood mafia connotation entirely. It's just literal terminology, asset-based.
Exactly. And to answer why someone would choose it, we have to look at the mechanics of who is actually buying these properties.
Right.
The sources emphasize that these loans are strictly for business investment.
Okay.
Owner-occupied homes are entirely excluded, so the borrowers are entrepreneurs.
They're running a business.
Yes. They often buy heavily distressed properties in aging neighborhoods that a conventional bank refuses to touch.
Right. The houses with no kitchens.
Exactly. So for these operators, asset-based lending isn't about choosing a riskier option. It is very often the only functional mechanism available to acquire the raw materials for their business.
That makes total sense.
Yeah.
So if we understand that investors are forced to use these asset-based loans because of the condition of the properties,
Right.
it naturally leads us into how they actually structure the financing.
Right.
The sources reveal that the specific investment strategy basically entirely dictates the exact type of capital used.
It does.
It isn't a one-size-fits-all loan. It's more like following a business's growth cycle. So let's trace a hypothetical investor's journey, starting with their first project, which the sources call the fix and flip loan.
Yeah, the fix and flip loan is the absolute staple for targeting older, dilapidated housing stock.
Okay.
And the mechanism here is designed for extreme short-term use, typically ranging from 6 to 24 months.
But they don't just, hand the investor a duffel bag full of cash to go buy lumber, right?
Yeah. No.
The mechanics of this seem heavily controlled. The lender funds the purchase price, but they also provide a construction holdback reserve.
Yes, the construction funds are strictly managed. The lender holds the renovation money in an escrow account,
Okay.
and they only release it in draws as specific phases of the project are completed.
So how does that work in practice?
Imagine you're the investor. You tear out the walls and you finish the rough electrical framing. You don't just get to move on to drywall. You have to call the lender.
Oh, really?
Yeah. The lender sends a third-party inspector to the dusty job site to physically verify that the wires are actually in the wall.
Wow.
And only then does the lender wire you the draw for that specific phase.
That makes sense. It rigorously protects the lender's capital from being mismanaged, I guess.
Exactly. While keeping the investor from having to drain their own personal savings to buy drywall.
Okay, so our hypothetical investor completes a few flips. They build up some capital. Now, they want to stop selling everything and start holding properties for long-term passive income.
Right, building a portfolio.
Yeah. But they can't use a short-term fix and flip loan for a 30-year rental.
No, that won't work.
This is where the sources introduce the DSCR loan, which stands for Debt Service Coverage Ratio. And here's where it gets really interesting.
Mm-hmm.
The mechanism for this loan is entirely divorced from the human being buying the house. With a DSCR loan, you qualify based purely on the property's rental income, covering the principal, interest, taxes, and insurance.
It is a pure commercial cash flow analysis, but applied to residential property.
I love this concept. I mean, it's exactly like hiring an employee.
Oh, that's a good analogy.
Yeah, the house itself is the employee. And as long as that employee generates enough monthly revenue to entirely pay its own salary, its own health insurance, and its own taxes,
Yeah.
the bank looks at the business model and says, great, you're approved.
Right.
They literally do not care if the investor makes $50,000 a year or $5 million a year at their day job.
That analogy is spot on. If the monthly rent generated by the property mathematically exceeds the costs to carry the loan and maintain the asset effectively qualifies itself.
That is wild.
The human is just the manager of the asset.
But wait, I have a massive logical hurdle here.
Okay, lay it on me.
If the property essentially qualifies itself without anyone looking at my personal income,
Yeah.
what stops an investor from just scooping up 50 houses in a single weekend? I mean, if I find 50 houses where the rent covers the mortgage, why can't I just infinitely scale my portfolio by Friday?
It's a tempting thought. And it's a really common misconception about alternative finance.
Okay.
We have to ground the conversation in the hard mechanics of the transaction.
Right.
Yes, the property qualifies itself on paper regarding the monthly payments, but as the sources explicitly detail, the investor must still bring substantial liquid capital to the closing table for every single deal.
So the pawn shop still wants a down payment. You can't just walk in with nothing.
Exactly. These asset-based lenders might finance 70 or 80% of the deal.
Right.
But you still need to wire the remaining 20% plus closing costs, plus hold several months of mortgage payments in liquid reserve.
Oh, wow. Okay.
You will run out of actual cash in your bank account long before you acquire 50 houses in a weekend.
Yeah, that makes sense.
Yeah.
The math scales, but the capital requirement kind of anchors you to reality.
Precisely.
Let's look at another hurdle for our investor. What if they are self-employed? Like, they run a successful contracting business, but they take every single legal tax write-off available to them.
A very common scenario.
Right. This brings us to bank statement loans. I want to dig into the mechanism of this because it blew my mind. Traditional banking basically penalizes entrepreneurs. Right.
It severely penalizes them. Standard underwriting looks at your net income. That's what's left over after all your tax write-offs.
Right.
A smart business owner might gross $1 million in revenue, but after legally deducting equipment, vehicles, payroll,
All the expenses.
right, their net taxable income might look like $40,000. To a traditional bank, they are entirely unqualified to borrow money.
But the bank statement loan completely bypasses the tax return. Instead of looking at the net income on a tax form, the lender looks at 12 to 24 months of actual business bank statements, right?
Yes, they mathematically extrapolate the health of the business based on the gross cash flowing into the accounts every single month.
That is so smart. It allows business owners to keep their legal tax strategies without destroying their purchasing power.
It is a highly pragmatic workaround. It assesses the actual real-world cash velocity of the borrower rather than just, their optimized tax profile.
Okay, so once our investor is highly successful, the sources detail how they handle scaling up with less friction.
Mm-hmm.
They use bridge loans.
Yeah.
So let's say you have millions in equity tied up in your current portfolio, and you find a massive new deal.
Right. You need cash fast.
Exactly. Instead of selling a property, waiting for the cash, and risking losing the new deal, you use a bridge loan against your existing equity.
Yes.
You buy the new property instantly with a non-contingent offer, and then you have breathing room to sell or refinance the old one later.
It is the ultimate tool for leveraging existing wealth. In competitive markets, sellers despise contingent offers.
Remind me, a contingent offer is what?
Where a buyer says, I will buy your property, but only if my other property sells first.
Oh, right. Yeah, nobody wants to wait for that.
Exactly. The bridge loan entirely removes that friction from the transaction.
And finally, at the top of the food chain, we have ground-up and multifamily construction loans.
That's the big leagues.
Yeah, our investor is now building apartment complexes from scratch. And the sources provide a really stark warning here.
They do.
The mechanics of these loans involve strict draw schedules tied to municipal city inspections, not just private inspectors like the flip loans.
Right. It's a whole different ballgame.
The sources warn that investors must meticulously watch out for hidden renovation costs, soil testing delays, and these brutal prepayment penalties that can completely wipe out profit margins if the project stalls.
The complexity scales exponentially with the size of the project.
Yeah.
Moving from a cosmetic single-family flip to a ground-up multifamily development introduces entirely different risk profiles.
Wow, yeah.
The capital is readily available in this alternative ecosystem, sure, but the guardrails are much, much tighter because the exposure is so much higher.
So whether we are talking about a property paying its own salary as a rental or proving its own profitability as a flip, this entire system hinges entirely on accurately predicting the future value of the property before a single hammer is swung.
Yes.
If you get the math wrong, the asset doesn't cover its debt. Which brings us to the blueprint of how these deals are actually evaluated and funded.
This is where the theoretical strategy hits cold, hard math.
Right. The fundamental metric, according to the sources, is the ARV, the after-repair value.
Critical number.
Yeah, this single number dictates the viability of the whole project. And to calculate the ARV mechanically, you don't look at citywide averages.
No.
You have to look at recently sold, fully updated homes strictly within a half-mile radius of your target property.
That hyperlocal constraint is absolutely critical.
A half mile seems so small, though.
Well, if you are operating in a diverse metro area, crossing a major freeway or shifting into a different school district just a mile down the road can drastically alter what a buyer is willing to pay.
Oh, that makes sense. But so, what does this all mean? Let me push back on this, because it feels incredibly fragile.
Okay, fragile how?
Well, you were telling me an investor is basing a multi-million-dollar financial decision on a half-mile radius, projecting a value that won't actually exist until the renovation is finished in, say, 6 months.
Right.
What if the macroeconomic environment shifts? I mean, what if mortgage rates spike or the local housing market dips while you are literally tearing out the plumbing? You're projecting a future value that might just evaporate.
If we connect this to the bigger picture, that inherent fragility is the most crucial concept to grasp.
Really?
Yes, it is exactly why the entire alternative financing system is engineered around velocity.
Wait, so the speed isn't just about beating out other buyers?
No. The speed is the primary risk mitigation strategy.
Wow.
It is the hedge against the market dip. Think about the mechanics. A conventional loan traps you in a 30 to 45-day acquisition process.
Yeah, the cruise ship.
Right. Then you spend 6 months renovating, then 30 days selling. You are exposed to market fluctuations for the better part of a year.
That's a lot of time for things to go wrong.
But with a private fix and flip loan, you acquire the asset in 5 days. The loan duration is strictly capped. The mandate is to get in, force the appreciation through renovation, and get out before the broader market has time to undergo a massive correction.
Huh.
Time is your biggest liability.
That is a massive shift in perspective. Speed is a defensive shield, not just an offensive weapon.
Exactly.
And to further defend against that fragility, the sources mandate extremely rigid rehab budgeting. You can't just eyeball a house and guess the repair costs.
Definitely not.
The mechanics require walking the property with licensed contractors and holding a strict 10 to 15% contingency reserve in the budget.
Yeah, you have to have that buffer.
And this is specifically for what they call behind-the-drywall surprises.
Which are inevitable. I mean, you open up a wall in an 80-year-old house and you find outlawed knob and tube electrical wiring or a cracked cast iron sewer line. Underestimating those hidden mechanical failures is cited in the sources as the #1 way a new investor destroys their profit margin.
I can imagine. The sources also point to location metrics as a defensive strategy. They advise targeting properties near major biotech hubs, military installations, and universities. The logic is simple, right? These areas ensure a constantly renewing, steady pool of high-income tenants.
Always a demand.
Right. But the most interesting location metric they emphasize is finding ADU-friendly zoning.
Ah, yeah.
ADU stands for accessory dwelling unit, right? Like building a detached granny flat in the backyard.
Yes, exactly.
Building an ADU forces equity and artificially increases the density of a single lot.
It is about maximizing the yield of the land itself rather than just relying on the primary structure.
Okay, so once an investor runs all this math, calculates the half-mile ARV, budgets for the nightmare behind the drywall, and feels confident, how do they mechanically get the lender to wire the millions of dollars?
Well, there's a process.
Yeah, the sources break it down into 4 strict funding steps. Step 1, an executed purchase contract. The lender needs legal proof that a transaction is actually occurring.
Of course.
Step 2, a detailed line item scope of work.
Which directly ties back to the draw schedule we discussed earlier.
Right, where they check the wires in the wall.
Exactly. The lender needs to know exactly what every single dollar is doing, from pouring concrete to installing cabinets to justify holding back those construction funds.
Makes total sense. Step 3, LLC, or corporate entity documents.
Yep.
Almost none of these deals close in a human being's personal name. It is done through an LLC to shield personal liability and solidify the fact that this is a commercial transaction.
Essential step.
And finally, step 4, verifiable liquid capital in a bank account. We touched on this earlier.
The down payment.
Right. The lender demands to see your cash. They need to know you have personal skin in the game.
Fundamentally, it is structured as a partnership. The asset-based lender is putting up the vast majority of the capital, but they mathematically force the investor to share the risk and flawlessly manage the execution.
It is a totally different paradigm from just applying for a standard 30-year fixed mortgage to live in a house.
Completely different universe.
To summarize the overarching lesson here for everyone listening, why should you care about how a real estate investor gets a loan?
Yeah, why does it matter?
Because in the modern information economy, agility and alternative frameworks very often beat traditional bureaucratic pathways.
Absolutely.
Even if you never plan to buy a single piece of real estate, understanding how this asset-based evaluation works provides a really fresh lens for evaluating any business risk or opportunity in your own life.
I agree.
It teaches you to look at the intrinsic mathematical potential of an asset, rather than getting bogged down by the historical paperwork of the operator.
It shifts the fundamental question of business from what have you done in the past to what can this specific asset produce in the future.
Exactly.
Yeah.
It is about understanding how to evaluate the gold watch,
Yeah.
rather than obsessing over the credit score.
This raises an important question, though, especially regarding the long-term impact of these strategies on everyday people.
Oh, how so?
Well, we talked about how these investors target ADU-friendly zoning to force equity and increase property density on single lots.
Right, building the granny flats in the backyard to maximize the yield of the land.
If specialized alternative financing allows institutional and professional investors to rapidly bypass traditional banks and sweep up distressed housing inventory in 5 days flat,
Yeah, in their speedboats.
right, and then convert single-family lots into hyper-dense multi-unit rental compounds. What does that mean for the fundamental character, the housing supply, and the future of traditional suburban neighborhoods?
Oh, wow.
It's a big shift.
That is a heavy structural thought. We're talking about fundamentally altering the physical and demographic landscape of a city, lot by lot, at absolute maximum velocity. While the traditional homebuyer is still stuck at the bank, on that cruise ship, waiting a month and a half for their paperwork to clear.
Just hoping they get approved.
That is definitely something to mull over. Thank you all for joining us on this deep dive. We will catch you next time.